Hi, and welcome to Macro Monday, where we talk macro, try to make sense of markets that, well, you know what? Today they might make some sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because I have a great show lined up for you today. I was kind of upset. I don't want to say upset, but starting on Friday, I went through a mental tirade over the weekend to revisit a topic that I've written about, but I'm too lazy to go dig up the writing and share it with you. So I just thought we'd rehash it. It's called How Banks Are Going to Crash the Markets. I even wrote notes because I wanted to make sure I got all of my points across. And I don't think people fully appreciate in the macro space how important the large commercial banks are and what they do. And this is why every Friday we go through the credit data, but it's also important to see how they're positioning in the markets. What are they telling their clients? Are they saying short the bond market? Because you can guarantee if they're telling their clients to short, it's because they're long. So what are they up to and how are they going to crash the market? Now I will forewarn you, there is going to be a little political commentary in this. So if you have sensitive ears, maybe when the time comes, we'll use a code word. I'll say like rabbit, and then you can tune out and not be bothered by my whatever opinions I might have on this. Now on Friday, big friend of the show, Chris Dark, posted on Twitter that he noticed that the large commercial banks were buying more Treasury securities than the Fed is. They are. We know that because we look at the data every week. And so this comes back to how are the banks going to crash the stock market? Well, it's real simple. See, we know the banks are buying more bonds than the Fed. And we know that QE is not working. Now, you go, what do you mean QE is not working? It's not. It's not working at all. Because here is Treasury yields, right? And Treasury yields, we'll go to 10-year. Treasury yields tell you everything you know in real time about the economy. When financial conditions are easing, yields go up. When financial conditions are tightening, they go down. And when they are unchanged, so from March to now, we'll zoom in, it tells you that all of the QE monetary stimulus and all of the government fiscal stimulus has done nothing to ease financial conditions. And this is on top of a period where you have near record long speculative short positions by hedge funds, which we'll look at a little bit later. And you had during this period banks buying their stock back, both of which put upward pressure on yield. So despite that, financial conditions have not eased at all, suggesting that we're heading into an insolvency event as yields go lower. So yields are starting to turn lower. We've looked at this. We've talked about this. Well, pretty much every show, because isn't this the bond show? So we know financial conditions are going to get tighter. And so this tells us that rates are too high. Oh, what do you mean rates are at record lows, Steve? How can you say that rates are too high? Simple. What did we learn on Friday about the lending data on a 90-day basis? Commercial industrial lending contracting, residential lending contracting, credit card contracting, and all loans and leases in contraction. So credit is contracting. Now, have you ever thought about how banks make money? I do, because, hey, what the large commercial banks do matters. They are the smart money. Not all of the smart money, but they are the smart money. So banks make money when they lend. So if lending is contracting, what does that tell you how things are for the banks? Not going well, right? They're not doing enough loans to expand their loan book to make more money because lending is contracting. So how do you get people to borrow? I'll let you decide. Do you raise interest rates or do you lower interest rates? Would you be inclined to round out and borrow if interest rates double tomorrow? Or would you be inclined to borrow if interest rates got cut in half tomorrow? What would you think? Well, if you guess that interest rates going down get people to borrow money, that's generally correct. So if interest rates need to go down, how do you get lower rates? If you're a large commercial bank, how do you get lower rates knowing the federal funds rate's at 0 and the Fed's doing quantitative easing is having no effect? None, because yields have not changed since March. How do you get interest rates to go down so you can lend more, because lending growth is contracting and your business as a result is contracting? Well, simple, you buy bonds. Now, doesn't that start to make sense of why the large commercial banks are so important in the macro space? So late last month, the banks started ramping up their bond purchases. They were already buying them because they've got lots of regulatory reasons they have to buy them. Plus, they've got to have them to sell to the Fed for quantitative easing. But they started buying even more. Now, why is that? Because they need rates to go down, and no one else will do it, so they can do it. They'll just start buying more bonds. And then what will happen when the banks buy more bonds? Well, financial conditions will tighten, right? Interest rates will go down. And we know for a fact that when interest rates fall, financial conditions tighten. If you don't believe me, you can study Milton Friedman's research. He was the first person to figure that out. He didn't solve it, but he started to postulate that, yes, this is what lower interest rates are not inflationary, they're deflationary, and they mean tighter financial conditions. Makes perfect sense based on our monetary system. And if financial conditions further tighten, what do you think is going to happen with the stock market? Oh, it's going to go down. Why? Because when interest rates and stocks move in the same direction. That's why I have two arrows that are red going the same direction. So if stocks drop and yields drop and financial conditions tighten, what do you think the Fed's going to do? More QE. You see, the banks can make the Fed do what they want them to do. It's really simple. You want the Fed to do more QE? More QE? Tighten financial conditions, cause stock market to crack and go down. And the Fed will do more QE because what does QE do? Puts downward pressure on yield, or if there's enough of it, can actually drive yields lower. And after all, don't you think that Powell owes the smart money for what they've been doing? They've been buying up all his bonds. You know, they've been helping. The commercial banks have been buying it. We've seen the smart money's buying it as based on their positioning in the futures market. We know there are people out there that have been buying bonds to help Powell. And what do you want when you give someone a favor after a while? You want to get paid back. And how are all these people going to get rid of those bonds? Now, years ago, I told my clients the reason we're buying bonds is because I know I'm going to sell it to, which when I told them it was the Fed, they thought, how are you going to do that? Well, I'm indirectly going to sell them to the Fed because the Fed's going to do so much quantitative easing that literally it's going to be like turning the garbage disposal on, just throwing it, putting stuff in. The Fed's going to just chew it up. I mean, this is the biggest garbage disposal you could see. And they're going to eat up a ton of bonds. And if you have them to sell, it'll be an easy time to do it because Fed's going to be buying so many of them at such a premium because they're going to drive rates down. And Powell's going to need to bail out the banks because financial conditions are going to tighten. Lending is contracting. It's not good for banks, not good for the Fed. Now, here's where we're going to get into the little political commentary. So, code word, rabbit. So remember, if you don't like this stuff, turn it off. Wait a few minutes and we'll be back. Powell wants to keep his job, and not long after the presidential election, early next year, Powell's job's up. He has to be renominated for his position effectively. Now, President Trump or President Biden, whoever happens to be in office, can keep him. The general view is President Trump is not going to keep him, and Biden probably would pick his own person. So the odds of Fed Chair Powell being out of work is pretty high. Now, despite popular belief, the President of the United States is not the most powerful man in the world. That position goes to the Fed chair because they can make or break anybody based on monetary policy. So he's in a very powerful position. Whether it's uncomfortable is a different story. Now, what does Fed Chair Powell want? Do you think he wants to go out a chump, the guy that didn't save the economy? Or do you think he wants to go out on the cover of Time magazine like his predecessors, you know, the Superman who used monetary policy to save the world? That's how he wants his legacy. I can assure you he does not want to go down as a one-term Fed chair that didn't do what he needed to do. That's not what he wants. Nobody wants that. All right, so he's going to do what it takes. He wants to be a hero, not a zero, and to keep his job. Now, this gets interesting twist. Who do you think Fed Chair Powell would prefer to have president, Trump or Biden? Trump. Okay, now think about this. Odds are Biden wins. He could get anybody else, maybe someone who is a Democrat. I don't know if Powell's, I'm assuming he's a Republican. I don't know for sure, and it doesn't really matter. But I'm going to assume that Biden brings in his own person. So Powell's best odds at keeping his job is keep President Trump in office. Now, how's he going to do that? But wait, Steve, you said stocks are going to crash. Bingo. So how's that good for Trump? Before we answer that question, think about this. Let's say President Trump wins again. And my thesis of a big market correction, massive QE comes into play. And let's just say that works, even if psychologically and temporarily it works. Would President Trump, in his second term, be able to fire Powell? No, not a chance. Powell's going to walk into that meeting and be like, go ahead. You get rid of me, the market's going to tank. I am keeping the markets up for you. He knows it. He knows it. Okay? Think about this. There's a lot of moving pieces going on here. It's all predicated because why? The banks need interest rates to go lower because lending growth is contracting. Right? Can't make money if your business is shrinking. All right, so what's going to happen then is stocks are going to crash. Trump's not going to like it. He's going to be in bad place because remember, that's kind of been a big point of, vote for me. I can make stock prices go up. So what are they going to do? This is where it gets interesting. What are they going to do? They're both going to come out and talk the market up, right? Powell's going to use forward guidance. He's going to use his arsenal of Fed minions. Get them out. Talk the market up. And Trump's a master at this. He does it all the time. He's going to talk the markets up. Now it's interesting that we say that because people don't have this power to talk the markets up. I mean, that's silly to think that someone could just talk and things go up and up and up. But why are the markets acting like that? Well, there's two reasons. One is there are computer algorithms that read the news and react accordingly. And what are things they like? Quantitative easing and most things that President Trump says. And believe me, Trump knows certain things that he says has a positive reaction to the market. He knows that. And Fed Chair Powell knows that talking about more quantitative easing, these computer algorithms are going to eat it up. Now, there's a second thing that's going to happen. There are these things called high-frequency trading algorithms. If you don't know what they are, you have to go look them up. But effectively, what they do is they front-run and scalp pennies off of trades. They don't care about the news. They care about the amount of money flowing into the into the markets through them. Now, you don't have to trade through them. So, for example, I, as an institutional money manager at TD Ameritrade, I can trade directly through the markets through them, or I can trade through my trade desk outside of them. But here's the interesting thing. Small trades have to go through them, have to go through the HFTs. Can't get around it. That's just the way the world works now. So the more places that are going to zero transaction fees, it means all those trades are getting front run by high frequency traders. These things do not care what the news is. They don't care about fundamentals, valuations, profits, earnings. It doesn't matter. All they care about is trying to nudge prices higher so they can scalp money off of them. The other thing that's going to happen when there's a big dip is a lot of professional money managers did not chase the March low. They didn't do it because they believe that you should buy stocks based on things like, fundamentals, profits, earnings. They're not going to make that same mistake next time. They're going to buy the next dip. So when you have computer algorithms that are going to start bidding prices up, high-frequency traders that are going to force prices up, and you have a flood of institutional-level money coming in because, hey, they look, and I'm with them, Hey, you didn't buy the dip because you were actually doing the right thing by not buying overpriced stocks. Next time, going to buy them. That's just how it's going to work. Because the support under the market is these high-frequency trading algorithms. And what's going to happen is you're going to see stocks go up, 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 fast. Because the computers know the game now. And Trump's going to take credit for it. Now, I'm not saying it's going to work for him. I'm saying he's going to take credit for it, and so is Powell. And if Trump wins, Powell keeps his job. Pretty interesting. It's all interesting that we're seeing this happen because the banks need to buy bonds because no one else will buy enough of them to get interest rates lower. So they're going to do that until they tighten financial conditions enough to force the Fed into doing more QE, which is going to crash the markets like we saw the last time the Fed did QE. And then the question is, how does it all shake out for the election? Can Powell save the day, be a hero like his predecessors? Can Trump talk the markets up? Don't know. How will people feel about it after going through two big drops in their portfolio? Will that change their mind when they go to the ballot? I don't know. But it gets really interesting when you start seeing why, from a macro perspective, why the large commercial banks matter and how this is all potentially going to play into the election. So many people said, well, you think stocks are going to crash ahead of the election? Yes, I do. And I'm even more convinced now because of the banking data. And I've said before, and I'll stand by this again, I think rates come pop back up to around 1.5%. And you said, well, how is it you can think 1.5%? I'll show you. Here's 30-year yields. Here's 1.5%. Here's 1.5% right in here. Do you know what kind of lending growth we have at 1.5% right now? Yeah, we have negative lending growth. So all the people say, well, your rate should be 3, 4, 5, 10% on the long bond. And what kind of lending growth are you going to have? None. Negative. That's your resistance level. It's based on the fact that we can't get lending growth at 1.5% on the 30-year. Let's take a look at the economic data. It's not much to look at, but let's take a look at it. Going to, let's see, this morning, we have German WPI. WPI is wholesale price index. And on a year-over-year basis, still it's improved slightly, but it's still in contraction, still deflation in the wholesale prices at minus 3.3%. And then this morning, no, I thought we had something else. Maybe that's it. Now tomorrow, we're going to start getting CPI information out of the foreign markets, out of Europe, and then the U.S. we get CPI. The prediction is on a year-over-year basis, it goes from 0.1 to 0.6. I'll take the under on that. I think CPI is far more lagged than that, and maybe we even get into negative territory. That would be pretty interesting. Keeping on the Red Book retail sales as well, that should be of interest. Let's take a look at what's going on with the Fed. Now, in macro, the Fed is, look, if you're studying macro, you need to study the Fed. It is one and the same. Now, today, the Fed announced their upcoming QE schedule, and I want to look at that and show you this. So the desk plans to purchase approximately $80 billion over the monthly period. So effectively, no changes, as Powell said. And this is important because, just because Powell comes out and says, hey, we're going to maintain a $120 billion floor on QE, doesn't mean guy can't change his mind. So it's very important that on these release dates, I like to go look and just see, all right, what are we doing? So the good news is we're maintaining what he said, so that's good that we can take him on his word. And then you can click on the schedule for the upcoming period. So we're going to see 7/14 to 7/27. So other than this coming Friday, there are QE purchases every day. Now, notably, because remember, we're looking at the long bond, there's 1, 2, 3 long bond purchases at $1.75 billion each, and that equates to $5.25 billion of long Treasury bond purchases in the next 2 weeks. And remember, there's not that much supply that came on the market from this last auction. I think it was $3.3 billion that went to the security dealers, assuming that entire amount gets sold to the commercial banks who then offload it to the Fed. That means the Fed's buying more long bonds than there is supply in the market, which is great news, because what does that mean for long yields, which would mean for intermediate yields and would mean for short yields? Lower. QE is doing exactly what it's supposed to do. Let's take a look at how hedge funds are positioned in the market here. Now, if you're new to these charts in the show, just to kind of refresh how you read this, the short positions are in green. What are the long positions? They are exactly inverse. The hedge LP, he doesn't draw them on here. There's no need to. But for every negative position, there's a positive position. So we're seeing hedge funds and other speculators start to increase their long positions on 10-year treasuries for the second week in a row. It's not really until they're much higher up in their long positions that we should see a bottom in Treasury yields. Remember, yields don't bottom until speculators are long, which brings me to some very interesting data on the 30-year. They're extremely short. They're effectively unchanged from the prior week, meaning there's a heavy short position on the 30-year long bond with the Fed continuing their purchase program. So in order for long rates to bottom, you're going to need to see these green bars be way up here somewhere. So if you're long treasuries, as I am, you see this, you go like, nothing to worry about, because I'm going to have plenty of people to sell to when they flip long and the Fed turns on the QE engine again. And probably what's going to happen is the Fed's going to turn on QE, turn it up, and squeeze all these people out like I've said they will do. And they did back in the great financial crisis. It'll cause a big crash in yields. And that means it'll place a nice exit for anyone who owns the treasuries who wanted to get out. And maybe come back in later or some point. How about West Texas Intermediate? There's a huge amount of long positions. They're backing off slightly. To me, this is baffling because, well, given the state of the virus spreading in the United States and people not traveling with school, the big travel season now pretty much behind us for the summer and schools getting ready to start in some capacity, this is not good. To me, these people that are very long crude oil are in for a rude awakening because we should see a lot of massive draws recently, and we're not. And, if you're hearing something about OPEC right now, where they're going to taper off their cuts, it was already planned. This is not new information. It's been planned for a while, but they're supposed to, I think, meet Wednesday and discuss their, bringing production, increasing production back up a little bit. So not good for all these people who are long crude oil and betting on inflation. How about on the short side of the market? We can see the S&P 500. Those shorts have been backing off, which has helped pushing the S&P 500 higher as speculators are, nudging into the long area. They're not there, but they're backing off, headed that way. How about we'll come back to gold. NASDAQ, they're getting pretty long on the NASDAQ, not as long as they've ever been, but they're getting back there as the NASDAQ continues to defy all forms of logic, which I'm sure entering season will help people understand how much they've been overpaying for their tech stocks. Russell 2000 small caps have backed off their longs a little bit, and with that, they're increasing their shorts on volatility. Keep in mind, this is a dangerous game to play in the VIX complex because, and I can see this as someone who has sworn off trading volatility forever. I hope forever. No positions, not taking any. Yes, slightly tempted, but won't do it. Anyways, this is a dangerous game when you're short vol playing against the Fed, because one thing that I understood in my positioning was the Fed creates volatility through QE, and a lot of people don't understand that that's how it works. And so there's some danger to me, in my view, if we go and look at the VIX index right now. It did close over 31. This is my danger zone line. It was a VIX at 31. I did not know this until I just clicked on this. I did not realize it shot way up there. But volatility now is at risk. If I'm sure traders will come and try to suppress this. But you start getting over this 31 level, and it's going to spring higher. And I think it blows through these March highs. I really, really do think that's going to happen. So dangerous place to see these hedge funds short volatility. And remember, volatility doesn't peak until they go long. Ouch. How about the dollar? And then we'll come back to gold. Speculators are still short the dollar, but no real change there. The smart money is long dollars currently. They're the opposite of that. And let's see, gold, still a lot of long positions here. Everybody's really bullish on inflation. Guess we'll find out more tomorrow when the CPI comes out, just how much inflation we really actually are getting from all of these fiscal and monetary stimulus packages. And I think market may be in for a surprise. that there really isn't, at least in headline inflation. Maybe there's real inflation, but certainly no headline inflation. All right, let's hit a couple charts real quick. There's one question in particular I want to address, maybe a couple of them. We'll see if time allows for it. Look at the S&P sitting right kind of at this trend line, again, facing if it breaks down here, meaning the bulls are just actively needing to fight this higher. How about the bond market? Getting a nice reversal on 30-year yields here that actually closed a little bit lower. And again, you look at the 30-year, it starts to get much below this 1.25 level. And there's really not a lot holding it back from hitting its lows, all-time lows, and probably near zero, especially when you factor the Fed having to turn the QE engine on there at some point. How about energy stocks, which is going into tomorrow's API report, which is after market close, and then Wednesday's crude oil inventory report? You could see it found support here at $34 a share on XLE, the largest energy ETF. But look, no real buying today. Again, you break this 34, and there's really no reason why we won't see a retest of the lows. Could be a double bottom, could break through there. My bigger guess is we break through that. Let's take a look at TLT, and maybe we'll pick up the dollar. Big day in TLT. Now, remember, I kind of was curious and maybe offhanded predicted that it would be a good day for the long bond. Started out lower after the midnight sellers, as I dubbed them. Midnight sellers, see, we're in the sell zone. They needed to sell. Then their sell zone came down here. But today had a nice rally. Keep in mind, the QE auction was pretty much roughly around this time scale right here. And then bond prices kind of ticked higher, broke through this dotted purple line, which is overhead resistance, and then found some push higher there. Again, this is great position as we look to see bonds break through this 170 level, and at that point, I mean, the sky's the limit on the next big move higher in bonds. And the last thing we'll look at for questions is the dollar after getting into the sell zone here, or the buy zone again, found buyers again for the third or fourth day in a row. Let's hit over to some questions. There's, like I said, there's one in particular I want to get to, because I keep confusing this person inadvertently. And I normally don't reply to questions. I do reply that I got it and whatnot, but I normally don't reply, and I felt I owed that person a response. In your Sunday's Q&A, someone asked investors they didn't ask investors, it was more so if the banks could run out of money to purchase U.S. Treasuries. And I interpret the question as, could the banks run out of money to purchase from the securities dealers? And I answered no, because banks can create money which could be used to purchase U.S. Treasuries on credit. And here we go, because I've asked similar questions before, and this is the third time you flip-flopped on the answer, so I'm confused again. You previously said you don't believe U.S. Treasuries can be purchased from the Treasury on credit. That is correct. I do not believe that you can purchase U.S. Treasuries on credit from the U.S. Treasuries at the auction. So kind of what I explained to them in the email is, post-GFC, there were safety nets put in place to make sure that whatever debt needed to be issued would be bought. And there's literally a spot, in the banking stuff that I've looked at where I have an understanding and then I have none. Like I know there's more there. I've kind of seen it. It's really beyond my comprehension. I don't know what the safety net is, but the large commercial banks aren't going to run out of money. I don't know the mechanism for it, but I do know there's two things. And I think the question here is it possible? Well, I know the question is, because we kind of went back and forth. Is the government borrowing money inflationary, or can it be inflationary? And the answer is no. So the government borrows from the pool of dollars that are in the system. You cannot go to the U.S. Treasury auction with borrowed money. I mean, maybe you can borrow money, but the system is not created that way. So, maybe someone does borrow money and goes to an auction. I don't know. But it's not that money gets conjured up and hits that auction, because that would be effectively inflationary, and we know it's not. We can look at the data. The second piece of this comes into where I think the confusion is, and in my view, unsubstantiated, is there is a safety net to what accord I do not know. But I do know exists, and I do know that push come to shove, the commercial banks will somehow mop all of this up for the Fed to buy through QE. How they're going to do it, I do not actually know. I don't know. Some people have postulated the banks can create money short term. Maybe that's how they do it. I don't know. But in terms of the banks, large commercial banks going to the Treasury auctions with borrowed money, it's not going to happen. It's foreign investors, domestic investors, and securities dealers, not borrowed money. So hopefully that helps. And I apologize to this person if I've confused them. And like I said, there's just a point in the banks that I just don't know. And it's not something I really am going to spend a lot of time trying to figure out, because if you try to read some of the stuff, you're like, oh God, it's just black hole. My last question I asked, how does the M2 go up from the stimulus? Is supposedly the money to fund the stimulus should come from the M2. Now, this is not necessarily true. Foreign money does not get reported in the M2, and foreigners buy a lot of U.S. Treasury bonds. Securities dealers, who I do not, I think we've already verified that their money does not show up in the M2. They buy at the Treasury auction, so it's only direct investment, which ought to be in the M2. It should be, as under institutional money funds. I would imagine that's where we see the cash coming out of. You answer this depends on if securities dealers held the money in commercial banks in the first place, and I think we figured out that it wasn't the case, and that your friend Chris Dark may be more knowledgeable about this and might be able to answer it. Could you pass the question on to him? Well, I know Chris watches the show, so I think we already did confirm that this isn't the case. He checked with a friend of his, so I'm 99% sure the securities dealers their money is not showing up in the M2. If not in commercial banks, how else would securities dealer hold the funds they use to purchase U.S. Treasuries? I don't know. Thanks for your time, Steve. I kind of feel bad. I don't know if I'm really answering your questions or not. But again, there is a point where I don't know. I'm like pretty sure the securities dealer money does not show up in the M2. I'm relatively sure. Now where it shows up, I don't know. Maybe it's somewhere else. Maybe it's not shown there at all. I'm not sure how that works. And let's see if we have a chance for one more question. Hi, Steve. You discussed bank reserves along a step. My question is, why would the banks be interested in increasing their reserves held to the Fed based on how little they can do with it in terms of how little interest the Fed pays on reserves? Effectively, banks are swapping a highly liquid asset that is fungible for an asset that virtually can't do anything other than having it in their balance sheet. Thank you, and I hope you're doing well. Well, you're welcome. I'm doing well. And the answer is they don't have a choice. The Fed is going to buy those Treasury securities and mortgage-backed securities, and that's the simple end of the story. So they don't have a choice on this deal. All right, so let's kind of wrap things up there, and hopefully my friend who I probably botched all over your question, and hopefully I didn't confuse you further. I hope that helps, and I hope today's video kind of helps you think about why the commercial banks are so important, why the bond market is so important, why credit data is so important when it comes to macro, and whether or not you agree with kind of what I think could play out. So we'll say it's a prediction that may or may not happen. In the macro world, you have to think about these possibilities, because if it's correct, it could be a tremendous opportunity if you hold bonds to get out and buy risk assets. It could be, because you kind of know what certain players have at stake. And with election coming up, a lot of people have their jobs at stake. I'm Steve Van Metre. Thanks for taking the time to watch. We'll see you on Wednesday to see what the CPI data says. And take more of your questions, because I got more. The content of this video is provides educational information only, not intended to provide investment advice. This shows not to be construed as a recommendation or solicitation by a selling security, financial product instrument, or to participate in any particular trading strategy. This video is prepared by Steven Van Metre on personal capacity. Opinions expressed in the field that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.